everyone, this is Dimo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook video. There's going to be a lot of great fall pictures, as you can see in this video. I hope you guys enjoy it, and thanks again. Okay, here's a quick recap on the asset class returns. As you can see by the blue parts of the bar chart, we see a lot of them above the zero. So we had a pretty good month overall. I'll highlight a few things here. You can see large cap had a nice plus 8% return. Now the Dow, which is a component of large cap stocks, actually had the best month it's had in about 40 years. So that was really nice to see. And this is quite common when the market's down to have these big upswings. You saw that also with small cap stocks, even a bigger upswing. So we'll have to see if that can continue. Small cap stocks can be a leading edge to what is to come. We'll see. Real estate still struggling quite a bit. Rates kept moving up a little bit, so that's kept it from participating quite as much. International still struggling. Developed markets went up a little bit, so that was good to see, but not as much as the domestic stocks. And emerging markets are still struggling. The zero COVID policy from China is really still dragging their economy. Fixed income had a little bit better month overall. You can see still a little negativity with the high quality fixed income. But the high yield did a little bit better, up 3.7. Again, this has been a horrendous year for the fixed income markets, the worst we've seen in multiple decades. This is a much worse market for the bonds, relatively speaking, than the stocks. Okay, and we saw commodities bump up a little bit. That was nice to see, and they've done pretty well for the year. And again, with a recession coming, maybe that will be changing. But that's a quick recap of the asset class returns. Okay, and here's the latest on the Fed. As you can see by my graphic here, the Fed raised rates by 0.75 again, and this was just last week on Wednesday. So this was a recent raise. We are now at 3.75% to 4% on the Fed funds rate, which is the short-term rates that the Fed can control. Now, the reason they did this was, again, inflation was a little hot for the previous month, I guess the October numbers. And so they're, again, trying to slow down the economy so that they can slow down inflation, because inflation is a really bad problem that they want to stay ahead of. I feel like they're a little bit behind, so they're just trying to do some catch-up at this point. Now, what really moved the market was the fact that they said that they're going to maybe be even more aggressive than they thought they were going to have to be before. So that's what moved the market kind of down a little bit part of last week. The news from China kind of brought things back up, so that was kind of the tug-of-war of last week. So they're saying that maybe they'll get rates to closer to 5% by next year, which we're at 4% now, so maybe they're getting close to the end. We'll have to see. Again, a lot of that has to do with how bad the inflation numbers are. And so we're going to have a big inflation number print that's going to come out this Thursday. I think it will still be a little hot. It's going to be a little bit better as far as year over year, but it's still going to be a little hot, which means that the Fed is going to keep pumping the brakes here on the economy, unfortunately. All right, and a quick economic update. We just had the Q3 numbers for GDP that came out, and they were actually surprisingly up. Up 2.6%. So after two negative GDP prints, a lot of us were already just assuming it was going to be negative again. Now, I would say that this does not mean that a recession is over and we had one and it's over. It's just kind of quirky how these numbers work out. COVID and everything has thrown things off. But I would say that it's actually a good sign. It shows that the economy is maybe a little stronger than we thought, and maybe when we go into a slower down than we are now, recession in 2023, that maybe it won't be quite as bad, because again, there's a lot of aspects of the economy that are still somewhat strong. And again, we also had a number on Friday from the jobs report that we're still growing jobs, even though it's starting to come down. It was actually a good thing because the Fed wants to see the slowdown, right? And the unemployment number ticked up a little bit, but again, still pretty strong number overall. So if we're in a recession, we're definitely in one that is not hitting the job market too bad yet. Okay, the last part of the market update that I wanted to show you was the housing numbers. Okay, quick refresh. The housing numbers, or the shelter, that aspect of the CPI is 30% of the CPI. So whatever happens to shelter costs is going to have a big effect on the CPI. So that's why I'm bringing this up. And you could see that finally the Case-Shiller index, which is what's measured here, is going down. And this was actually one of the biggest dips we've seen month over month in a very long time. So that's I think a precursor to what we could see with shelter costs, which we could see in the CPI print. Now, unfortunately, what I've learned is this index lags, the CPI lags what's happening here in the Case-Shiller, so we may not see it right away. And the Fed seems to be very aware of this, so hopefully they'll kind of be watching this, also the CPI print. But this is definitely a good sign that inflation is certainly moving its way back down. All right, I want to start the market outlook with a yield curve inversion. Now, you probably heard me talk about this before, and you've probably heard this a lot in the financial news media, especially as a precursor of some ominous things to come. And that could be the case. But the one I specifically want to show you here is the 10-year minus the 3-month. Now, this is the one that has had the highest accuracy of being a precursor to a recession. You can see in 2007 that it went negative. You can see in 2020 that it went negative. And these gray lines show the recession. And what I want to show you is we're starting to see a negative inversion, or what's called an inversion again. So again, this builds my confidence even higher that we are going into some sort of recession. This doesn't necessarily predict how bad a recession it will be, but it's definitely a precursor of one that is to come. Now, usually once you get a yield curve inversion like this, it's usually within 3 to 9 months that we see a recession. So I think that's probably the case here as well. So I'll be talking about this a little bit more in the implications and how we prepare for this. So I want to show you this chart that talks about how the economy lags what the stock market does. And the reason I wanted to point this out is because you hear me talking about a recession coming, and I think a lot of people think that maybe the stock market is going to get much, much worse than it already is now. And that's not actually what I mean, because the stock market is leading the economy. Okay, and let me show you what I mean in this chart. So the blue curve here is the stock market, and the yellow is the economy. And so you can see when the stock market starts to go down, it usually goes down even before the economy peaks. I think we're probably somewhere around here right now, where the market's been down for quite a while now, and we're finally starting to see the economy slow down. And then what's going to happen is the stock market usually bottoms before we get to the bottom of the economy. And so we might be in a recession, and we might not even hit the trough till much later in 2023, but the stock market could already be recovering. And see, my point is that we might be going into a recession, but that's what the market has been anticipating and pricing in. And we could very well be already recovering by anticipation of maybe the Fed pivoting or at least pausing in the stock market before the economy even starts to recover. All right? Okay, here's my last slide. I always like to show you the Heartwood investment implications of everything that's going on and the outlook that I've shared with you. So first with stocks, what we're seeing here with stocks is with a recession coming, especially getting hardest hit in Europe because of everything going on with the war with Ukraine and Russia. We're going to be continuing to reduce the international holdings and add more to dividend and domestic stocks of dividend paying type stocks, a little bit more value oriented, a little bit more oriented towards energy, things like that will pay nice dividends while we're kind of going through the rough patches in the economy. And then in the bonds, I'm actually being a little contrarian here with the bonds. I'm reducing the TIPS, which is the inflation protected securities, and floating rate bonds, which tend to do better when interest rates are going up. And the reason I'm doing that is because I think we're probably pretty close to the market pricing in the Fed hikes. And so, in fact, at this point, I want to protect more from the recession and a slowdown in the economy than from inflation and higher rates in the future. And so I'm adding to higher quality bonds, a little bit longer term bonds by doing that. And then the last piece is the other, reducing commodities. Again, when a slowdown, the commodities won't do quite as well. I've been very patiently selling this down and adding to cash. Cash right now is actually becoming a lot more attractive with rates in the 3 to 4%, short-term bonds paying 4 to 5 almost percent, and so it's getting very attractive to have that little extra cash, and so I'll be doing that as well. So I hope this was helpful, guys. I hope you learned a couple things. Please reach out if you have any questions or concerns about anything. But thanks again for watching, and God bless.